For a long time, growth was the headline metric investors cared about most. Companies that could expand revenue quickly, acquire new customers at scale, and capture large markets often commanded the highest valuations. The faster the growth curve, the more excitement surrounded the business. But in recent years, something interesting has started to change. Growth is still important, but investors and executives are paying closer attention to a different quality of revenue: recurring revenue. Across industries, recurring revenue is being valued more than ever, and the reason behind this shift goes far beyond accounting preferences. It reflects a deeper change in how businesses, investors, and markets think about stability, predictability, and long-term value. To understand why recurring revenue has become so valuable, you first have to look at what it represents. Recurring revenue means that a company does not need to start from zero every quarter. Instead of constantly chasing new transactions, a portion of its revenue automatically continues because customers remain subscribed, contracted, or committed to ongoing payments. This creates a powerful advantage: predictability. When revenue is recurring, businesses can forecast future income with much greater confidence. Management teams can estimate cash flows, plan hiring, allocate capital, and invest in growth initiatives with a clearer understanding of what resources will be available. Predictability reduces uncertainty, and in today's business environment, uncertainty is one of the biggest risks companies face. Investors understand this very well. When analysts evaluate a company, they are not just trying to understand how much revenue it generates today. They are trying to estimate what that revenue might look like years into the future. Recurring revenue makes those forecasts more reliable. If a company has long-term subscriptions, multi-year contracts, or highly loyal customers, the probability that revenue will continue is much higher than if the company relies primarily on one-time transactions. That difference in visibility can dramatically influence how investors value the business. A second reason recurring revenue is so highly valued is customer retention. Recurring revenue models usually depend on maintaining long-term relationships with customers. Instead of focusing solely on new sales, companies must continuously deliver value to keep customers engaged. When customers stay for long periods, several positive dynamics begin to appear. Customer acquisition costs are spread across many years of revenue. The company has more opportunities to improve products, introduce upgrades, or offer additional services. And over time, the relationship between the business and its customers often becomes stronger. This creates what many executives describe as revenue durability. Durable revenue streams allow companies to weather economic fluctuations more effectively. When consumer spending slows or market conditions become uncertain, businesses with stable customer relationships often experience less volatility than those dependent on frequent one-time purchases. Another reason recurring revenue is gaining attention is the way it improves operational planning. Businesses that rely heavily on transactional sales often face unpredictable cycles. Some months may bring strong performance, while others may fall short of expectations. That volatility can make it difficult to manage inventory, staffing levels, and long-term investments. Recurring revenue smooths those fluctuations. Because a portion of revenue is already committed, companies can focus on improving products and services rather than constantly worrying about whether next month's sales will materialize. This stability also affects how companies think about growth. When revenue is predictable, management teams can take a more strategic approach to expansion. They can test new markets, invest in research and development, or build new infrastructure with greater confidence. The foundation of recurring income gives them room to make longer-term decisions. Another important factor is margin efficiency. Recurring revenue models often create opportunities for operating leverage. In many subscription or service-based businesses, the cost of serving an additional customer is relatively low once the core infrastructure is in place. Software platforms, digital services, and many modern business tools benefit from this dynamic. As the customer base grows, revenue increases faster than operating costs. Over time, this can significantly improve margins. Investors recognize this potential. Businesses that combine recurring revenue with scalable infrastructure often demonstrate stronger profitability as they mature. This is one reason subscription models have spread across so many industries. What began primarily in software has gradually expanded into media, entertainment, fitness, consumer products, and even traditional services. Companies have realized that recurring relationships with customers provide both financial stability and strategic flexibility. Another reason recurring revenue is valued so highly today relates to the broader economic environment. Periods of volatility have made investors more sensitive to risk. When interest rates rise, capital becomes more expensive. When markets fluctuate, forecasts become less reliable. In these conditions, businesses with uncertain revenue streams often face greater skepticism. Recurring revenue helps reduce that uncertainty. It gives investors confidence that the company has a foundation of consistent income, even if broader economic conditions become challenging. This stability can make the difference between a company being viewed as resilient or risky. Recurring revenue also changes the way companies think about customer experience. In transactional models, the relationship between a business and a customer may end shortly after the purchase. But in recurring models, the relationship continues. The company must keep delivering value month after month or year after year. If customers become dissatisfied, they can cancel their subscriptions or choose not to renew contracts. This creates a powerful incentive for companies to focus on long-term satisfaction rather than short-term transactions. Businesses that succeed in recurring revenue models often develop stronger customer support, better product updates, and more responsive service strategies. Over time, these improvements reinforce the value of the model itself. Another interesting aspect of recurring revenue is how it shapes competitive advantage. Companies with large, loyal customer bases often benefit from network effects, brand familiarity, and switching costs. Once customers integrate a service into their routines or operations, switching to alternatives can become inconvenient or risky. This makes the revenue stream more secure. Competitors may still enter the market, but they must work much harder to persuade customers to leave an established relationship. That kind of customer loyalty can be extremely valuable in competitive industries. But perhaps the most important reason recurring revenue is being valued more than ever is that it aligns business incentives with long-term performance. When revenue depends on ongoing customer relationships, companies cannot rely on short bursts of sales activity. They must consistently deliver value. They must improve their products. They must maintain trust. This dynamic encourages businesses to think in terms of years rather than quarters. It rewards companies that build durable systems instead of chasing short-term gains. In many ways, recurring revenue represents a shift from transactional thinking to relationship-based business models. And in a world where stability, predictability, and long-term resilience are becoming increasingly important, that shift is gaining more attention than ever before. Recurring revenue is no longer just a financial metric. It has become a signal of business durability, strategic discipline, and long-term value. And that is why, across industries and markets, recurring revenue is being valued more than ever.